Pay me, pay me, pay me my silver now. Pay me or go to jail. Pay me my silver
Bix Weir
now.
Road to Ruta.com. It is Sunday the 8th. Interesting week coming up next week. I think we should see a huge bump in the silver price. I think the commercials, judging from the commitment of traders, commercials are pretty much done. Squeezing blood from the turnip type of thing. So, I'm looking for a jump in silver. Who knows if it will be stopped by the artificial shorting on the COMEX. The law says that the COMEX can't set the price of silver. It's illegal under the law. Why have laws if you don't enforce them, right? But I did want to talk about something that is even bigger. A lot of people talking about the bond bubble, especially in U.S. Treasury bonds. Everything comes home to roost. When you print a hell of a lot of money, you got to expect some inflation to kick in, some problems in the bond market, especially because of the way the bond market works. Now, I put this up a while ago at Road to Road. Go to roadtoroad.com. This is from the FDIC, how much these banks are underwater on their bond holdings. We saw this really come to light at the beginning of the year with Silicon Valley Bank and all that turmoil in the beginning, because anybody who holds a bond, the bond market is an interesting thing because it will reflect what's going on with inflation. So if you don't think we're going to have inflation in the future, or if they're going to try to fake inflation, you're going to want to hang on to bonds. With inflation, though, you got to buy new bonds every time because they pay more. And I think that's what a lot of people really don't understand. The bond yield, they call it, the yield, the amount of the percentage of money you get for investing changes as the new issuances come out. The more they print, the more expensive it is for the printing party. For example, the United States of America, when they issue 10-year bonds, now they're paying out 4.8% on 10-year bonds. Just 3 years ago, they were paying out 0.7%. So and here's a good way to think about it. Say you invested in a bond 3 years ago. You're a bank. You got to put your money somewhere. They require you to hold reserves. And you invest in 2020 and you're buying U.S. bonds, the safest bond out there, right? It's going to pay you 0.74%. That was okay in the past, right? Because interest rates were around 0 or less than 1%. So it made sense. The problem is, over the past 3 years, the price, the yield of the 10-year bond, the amount of interest they pay you has gone up, 7 times to 4.8%. From 0.7% to 4.8%. So what happens is all those bonds that you had on your books that you bought 3 years ago are worth way less because bonds are traded every day, right? Every day the bond market's open. You can trade those bonds that you bought in the market today, but what will you get for them? Why would anybody want to buy your 0.7% yielding bond when today they can buy a new 10-year bond for 4.8%? Get 7 times the return. 7 times. That's huge. So they don't pay full value for the old bonds. Does that make sense? Those old bonds are worth a hell of a lot less than the new bonds because they're only paying out 7.4%. And there's, 7 years left on that bond. I mean, who would ever want a bond from 2020 unless you calculate the present value? How much for the next remaining 7 years, how much are you going to make off that 0.7% yielding bond, right? So you're not going to pay full value. You're going to pay way less to an amount that kind of equals where we are today or beats it. I mean, you'd really want to beat it. Otherwise, you just buy a new bond today and they keep printing them. So that's kind of the idea. So even bonds that were sold, let's go to the beginning of the year. Let's see, it was January timeframe. They were paying out 3.5% at the beginning of the year. Those bonds that banks were buying at the beginning of this year are worth a hell of a lot less now because now you can get a bond for 4.8%. So unless you plan on hanging on to that bond for 10 years, which is probably a mistake because look at the yield. Figure out what you're going to get and compare that to inflation that's going through the roof, and you're losing money by buying a bond. It is crazy. It is crazy, but that's how the bond market works. So we had this massive bubble. The mother of all bubbles was the bond market. And now banks have to keep, like, I don't think it's 10%. It should be around 10%, but I don't think it is anymore. They might have changed the rules. But they have to keep, let's just say 10% in safe instruments, and the rest they can create out of thin air. So when they get a deposit, they got to keep 10% of it, and they'll keep it in a bond because that's the safest, right? And then they'll create 9 times more, 10 times, 12 times. It depends what bank and what jurisdiction. But that's the way banking works. It's fractional reserve system. So it's all great when the market's going up and everything's happy and the bonds aren't going up because you're keeping your value and you have no problem paying. You're not going to get 20% of your customers coming saying, "Give me my money back," unless something like Silicon Valley Bank happens, where people all of a sudden look at the portfolio and say, "Oh my God, look what happened to Silicon Valley Bank." And this is from the FDIC. Look at this is what happens when you have a rapid increase in inflation. People say, "Oh my God, I get high yielding bonds. I need to dump my low yielding bonds because literally inflation's sucking the purchasing power away from me." So this has to go away, and the only way to get that to go away, these losses, is to raise interest rates as high as possible to stop inflation. Inflation is the killer. So let's take a look. They just inflation numbers come out on Thursday, and last month kind of shocked people because we really did start going up. Look, it was in June we bottomed at 3%, and then July is 3.2. August is 3.7. I think we're going to see a monster print for September. Why? Because of oil. Biden has sold everything he could from the strategic oil petroleum vaults, and there's no more he can take from there. So how are we going to get the price of oil down? And in September, if you look at what happened in September, right here, September started off at $80. And the end of September, it went to $90. That's 12%. Oil, gas, that whole world affects everything. Everything gets baked in. When oil goes up, everything costs more. Why? Because they got to deliver it. And it comes out of everybody's pocket. They got to deliver stuff. They got to ship it across the world. They got all kinds of things. Oil is it's the highest value commodity created, bought and sold in the world. So when it goes up, it affects everybody. It affects you at the pump, right? And it is supposed to be baked into the inflation numbers, although the government lies about these numbers. Now, I don't think they're going to lie much this time. They can't. I think we're going to see a print well above. I don't know what the experts are saying, but since last month we went from 3.2 to 3.7, I think we're going to go over 4% and continue to climb, just like we did back here. In the summer of 2022, we got up to like 9%, 9.1%. I think we're on our way back there again. And what does that do? That destroys the bonds, destroys them. And the only way to stop inflation is to raise interest rates above the price of inflation. So we're going to have to go way up there to 9%, 10%. Do a Paul Volcker, raise them to 20% for a short time. Oh, we might hit a recession. We already hit a recession long ago. They just changed the words. Oh, that's not a recession. They changed the definition of recession. It is insane what these assholes do, but that's the world we live in. And it's a world of make-believe. Now, anybody holding a bond that wasn't bought last Friday has been losing money. You're losing money. You're losing purchasing power. So last week, what did we end up at? last month. I think we're right up there. I mean, this is as high as it's been since. Let's look at the overall. That only goes back 2008. I mean, right there in 2008, when the financial crisis was happening, the 10-year hit 5, and we're like inching up to 5 right now. What does that tell you? It tells you we're about to dive into another one, but this one's so much bigger than the other crisis. The other crisis was mainly credit default swaps, which was $50 billion market, and the housing problem, the housing issue. Now we have commercial real estate is literally destroyed. If you have any investment in your retirement funds in commercial real estate, you're going to get pennies on the dollar. If you have any investments in treasuries, you're going to get pennies on the dollar. It might not look like it right now, but try to sell it. See what happens. It is insane. Okay, great article on Zero Hedge in the premium division. I'm part of that. The margin call moment. The world is now facing up to $70 trillion, with a T, trillion dollars in global losses. Remember what it took to bail out the United States and thus the world in 2008? It was what, $800 billion. Now we're looking at $70 trillion in book losses right now. They say earlier this week we discussed why the 74 basis point spike in 10-year yields would lead to an approximately $140 billion surge in unrealized debt losses on the U.S. bank books, which at the end of the second quarter amounted to $5.4 trillion in total duration exposure. As a result, total cumulated unrealized losses would soar to a new record of $700 billion, potentially triggering an expansion of the Fed's FTFP, temporary bank bailout facility. Yes, I do think that the Fed will continue to bail the banks out. And Greenspan was asked what would happen if the U.S. defaulted on its debt payments, and he said it flat out. It's impossible for the U.S. to default on payments. They can print money. The Fed can print money. Congress can print money. It's impossible to default on it, and what he said is, but you can't guarantee the purchasing power of that U.S. dollar. That's the key, the purchasing power. So yes, it will cost you $20 to buy a stick of gum in the near future, because that so far in the history of the Federal Reserve System, every problem, every financial problem, every war problem, every problem is solved by printing money. Solved by printing money. And that's why we see we're in the largest debt we've ever been in human history. And so if the system collapses completely with the derivative implosion, obviously it could, then we win, because all that debt goes away. No, you won't have a mortgage on your house. Nope, you get your house for free. Squatter's rights. Hope you have a gun. And it gets complicated. What about like apartment buildings? Who's going to evict you? How could they evict you? Everybody's lost everything. It gets so complicated. But the key is the old system has to be destroyed and replaced by something new. So let's see. Until we get detailed account of the latest bank balance sheet carnage, which is in 2 months, I think. It's a quarterly report by the FDIC. Maybe the Fed does it more often. A question has emerged. What about the total cumulative losses across all investors on the fixed income asset class? After all, it's not just banks that are suffering losses as a result of soaring yields. Losses on an asset class which is traditionally used in ultra-safe collateral across the repo market, and therefore any impairment could lead to massive margin calls both in and out of the banking system. Now, anything like that, when the banks start getting margin calls, it's over. It's game over. No bank can survive a run. Watch It's a Wonderful Life 100 times. And this is why the FDIC was freaking out at their annual meeting, or one of their meetings last year, the November of last year. They're like, what the hell are we going to do? We can't tell the public what's going to happen. Otherwise, it would cause it to happen, is what they said. We have to hide this from the public. The FDIC has $110 billion in their coffers, and not counting derivatives, people say they do guarantee derivatives. I don't think they do. I think they put that in there to guarantee that there won't be a bailout. But we'll find out soon enough. but it's somewhere 110 billion that they have, and I think it's 7 or 8 trillion that they insure, not counting derivatives. Counting derivatives, you're up in the quadrillions. I mean, it just gets to a point, and people say, "Oh, I can't believe they got derivatives. They had to pay out derivatives first." That's the best thing. You know why? Because they never would do it. You would never see it happen. That means nobody gets bailed out. That means the system collapses, and that's what we need. Any kind of rejiggering with Nesra or Jessra or some kind of crypto jigger is not going to work because it doesn't solve the problem. Misallocation of assets, rehypothecation of assets. I mean, these brokerage houses are so beyond criminal. They're trading phantom shares all the time. Look up the Heinz Corporation. It was a while ago. They got bought out, so they got taken private, right? And so everybody brings their shares to cash in for whatever dollar amount that they had, and they found out legitimately they had like 150% more shares than they ever issued, and they're all legit shares from the brokerage houses. It's like, holy shit, how'd this happen? And the judge who was like trying to solve this issue said, "This is unsolvable. I can't give a ruling on this. You guys figure out what to do. You guys are the ones who screwed it up. The brokerage houses, the never closing out deals. So it's like musical chairs." So yeah, you just threw it back to the banks and say, "Hey, this is your problem, not my problem." And they swept it under the carpet because they knew how big it would be if the whole world knew that, oh my God, it's all phantom shares trading hands. Why do I have a 401k if the things I own in there, the stocks and bonds and all that, have all been rehypothecated? Then Catherine Austin Fitts came out with her guy, I forgot, Skidmore, and said, it's not just a $30 trillion problem, it's $100 trillion in bonds that are being rehypothecated. So what are bonds really worth? Nothing. And what do the banks hold? They hold bonds. They hold commercial real estate. Jamie Dimon said, "I don't have a problem because I've got derivatives to cover." Well, derivatives will last as long as there's a counterparty to pay them off. You think any counterparty has $70 trillion to pay off? So Jamie Dimon, that guy is going to go down as the biggest financial criminal in the history of mankind, along with his minions, Blythe Masters. Haven't seen her for a while. Last I heard, she was on the HSBC chairman of the board, the world's biggest criminal silver rigger going back to the 1850s. I know. Anyway, so next Thursday we have CPI print. I think it's going to jump over 4%. That's going to freak out the markets again. Oil prices, who knows? It've come down a little in the last few days, but they're still way up there. So for September, they're up. It was 12%, 10. So whatever that is. I'm not doing the math in my head. About 12%. Up $10 on from 70 to 80, 71 to 81, something like that, or 81 to 91. Yeah, 81 to 91. So yeah, that's all going to be baked in now. At least the past couple of days, the price has been coming down, and it makes me look at it. I'm like, well, this is obviously a rig job. Somebody did it. I think it's the good guys. Somebody did it because they started exactly at in September at like, where is it? $81, and they finished on the last day at $91. Where's it? Yep, $91. So it just tells me, wow, they have that much control over market. It's just computers running their trading programs, trading back and forth with each other using the derivative market. Yes, oil and gas is not traded on a regular market either. It's on a derivative market. These are all derivative prices. Everything is a derivative. I remember when they moved shipping, the shipping rates. So the global shipping industry, it was like a cartel with the Greek masters, and they'd all kind of like collude to say, okay, here's how much it costs you to ship ocean liner full of gasoline to Zimbabwe, and it would be a number, and it would be a market-based number, so people would bid on it, things like that. Then probably, I was still in banking at the time, probably mid to early 2000s, they said, hey, it's more efficient if we put this on a derivative contract, and put it into the derivative trade, and that's what they did. Even though the shippers were saying, "What the hell are you doing? Get away from our market!" And now it's completely controlled by the banks. Freight rates are 100% controlled by the derivative market now. And I can't believe the ship owners, most of them were Greek, I think, allowed that to happen, but they did. They might not have had a choice. And now not even shipping rates are fairly traded. It's crazy. All right. Commitment of Traders report from last Friday shows what we knew. Because they slammed the price of silver, the commercials did the slamming, and they closed out a hell of a lot of contracts, short contracts. I don't know I haven't done the math, and then the managed money went short. So we have the perfect setup again for the 9 millionth time for silver to run again. And the question is, who's going to short when it starts getting up to, $25, $26? Who's going to short into the rise? And then at $30, who's going to short into that rise? I mean, the commercials have been doing everything they can for the last 3 years to try to get out of the short position, but it doesn't look like they are all the way. They get close. They're at like net, 30-something thousand, about 30,000. They're close, but they can't do it. And so they got to play the game again. And then they get it lower and lower and lower. When they go fully long, that's, I guess, when they say, okay, now we'll let silver be freely traded. As a matter of fact, we'll goose it up. Just like JP Morgan did in 2011. Silver didn't run from $20 to $50 because it was the little guy breaking free. No, it ran because JP Morgan put in Bill Daley as Obama's chief of staff, and they computer controlled the bid up. And it was easy to drive the silver price from $20 to $50 and got in all kinds of weak hands at $50, and then they slammed it down. Then they put the hammer down and drive it almost straight down the next week or so. It was back to mid-20s, and then when the day that Bill Daley left, it was back to $20. 1 year, a 1 year operation. I call it Operation Silver Slam. I was like on the road to it. I was describing it. I wasn't doing YouTube back then, but I was describing it in my daily blog, exactly what was happening, who was doing it, who was in charge, and where it'll end. And it ended exactly 1 year later when Bill Daley left the Obama staff, and so silver got absolutely destroyed, the weak hands, except J.P. Morgan made a massive amount of money on it because they ran it up, and then as soon as it hit $40 and ran to $50, they were massively shorting, and then they just hammered it. I think it was 3 billion ounces of silver were dumped onto the electronic market that night, Sunday, May 1st, 2011. The volumes were off the charts, and the CFTC was investigating JP Morgan at the time. But you have the CFTC with Gary Gensler running it, investigating JP Morgan, sitting on their desk while this is happening. And oh, by the way, Obama, who's the CFTC boss at the time, hired JP Morgan's hitman, Bill Daley, to be the chief of staff. I mean, it was so obvious at the time. And we've been in an artificial bear market since then in silver. I think we're still in a bear market compared to what's about to happen. When these assholes are gone, we won't see the price of silver going up over $30 even, or $50 on the COMEX. COMEX will be long shut down. And then where do we go for price? LBMA is not an exchange. It's a delivery association. Oh, by the way, everybody and their mother is now sending COMEX contracts to London for delivery. For this month, this has been updated to 55 million. 55 million ounces have been delivered in the exchange for physical. So you take your COMEX contract, you send it over to London, and they deliver it there, supposedly. Again, it's an association. That's the club. You're going to be in the club. It used to be the gold and silver fix. Every day was determined, I think, twice a day. And what an appropriate name for it, the fix. The fix was in. And it's a handful of criminal bankers that determine it. JP Morgan, Citibank, HSBC. They had the same old assholes. It was the Rothschilds were in there for a while, and then they ran away because it was too visible. They like to hide in the shadows. So that's where we are right now. I do think we're going to see a run-up of silver this week. It kind of started on Friday. Maybe they'll hold it off till after the commitment of traders cutoff, which is on Tuesday afternoon. And then I think it should run. And then the 8th, Thursday the 8th, is the CPI announcement. I think it'll be over 4%. Who knows where we go from there. Also, great Wall Street Journal article if you watch it. Here's how FTX executives secretly spent $8 billion in customer money. It was always a con. By the way, Sam Bankman-Fried is not the ringleader of this. It's Sam Bankman-Fried's parents, who are deep state pedo operatives for the cabal, the crypto cabal, and the other cabal. And they funneled a lot of these billions in to get Trump out. Talk about, rigging an election. I mean, can anybody halfway open their brain on the Democratic side and look at these judges? Did you see the judge who's trying Trump? The guy's a psychopathic freak. Hard to believe he's even a judge. It's really, but we live in such a bizarre world. Am I worried for Trump? No. I know this is all a fucking play. It is a play. It is a con. Trump never left office. Well, I think he gave it to the military to run for a while, but he didn't want the system to fall apart when Trump was there. They would have blamed Trump. The Democrats, see, and now we can blame, I don't know if you can blame Biden, because, the guy can barely eat his cereal in the morning without dropping it, falling out of his mouth, if it is really Biden. A lot of people say he's already gone with Hillary, but yeah, that's conspiracy theory. Don't talk about that, Bix. Okay. All right. So yeah, FTX, I don't know why his parents are not being tried. Sam Bankman-Fried, I listened to a podcast that his dad did, anti-Trump podcast, and the mom runs a Democratic money laundering operation. All this money was taken from your tax. By the way, your tax money was part of this FTX thing too. The money given to Ukraine went through FTX, and then they siphoned it off as they will. So Sam Bankman-Fried didn't do really much, I don't think. And he's being the fall guy, and everything you'll see is kind of a joke. And anybody who fell for it, how many times had I screamed in the past, not your keys, not your coins. Not your keys, not your coins. If you have a crypto and somebody else holds it, you don't deserve to reap any rewards from it, because you've been told time and time again. I remember I first started screaming that, in your own possession only, and nobody was like, oh, Bix, you're just paranoid, blah, blah, blah. They invested in all this DeFi bullshit. If it sounds too good to be true, it probably is. So yeah, cryptos will do fine in the long run. I have no idea where they're going during the crash. Well, I do, because you won't know the price of cryptos or anything. All the exchanges will be shut down. They have to deal on a fiat monetary system. When the U.S. pulls the plug on this game, there'll be no exchanges open, even in China. They deal on a fiat side too. Now, there are some decentralized exchanges, but you won't know the price. Not many people even deal in the decentralized side. So cryptos are definitely for the future. You want them in your possession, but don't expect to get rich next week off them. You won't know the price. Silver, on the other hand, it'll be interesting, because silver is the bank killer. When that card is pulled, if it is pulled, if we need something besides the bond market to kill the criminal cabal, it would be silver. And I think Buffett has sopped up probably 1 billion ounces of JP Morgan silver. That's my take. Just because of the connection between, I always knew Buffett was on the side of the good guys. If you read his biography, how much he idolized his father, look up Howard Buffett's speech in Congress about going back to a gold standard, and you'll understand what Buffett is lying when he says, "Oh yeah, gold's nothing, and you just bury it in the ground." And silver, the only reason I bought silver was a supply-demand deficit back in the late '90s. Not true. But, by the way, there's a huge, even bigger supply-demand deficit now. But he knows not to buy it on the COMEX. He knows not to get involved at all with that. He's buying it through Bank of America that leased over a billion ounces of silver from JP Morgan. That is all in the OCC data. That is 100%, it used to be. Now it's being hidden. by the regulators. They don't want you to know. But I believe the majority of that is ending up in Warren Buffett's hands, which he might be doing it for the good of the United States Mint. Don't know. Well, Ventures Gibson claims that she's greatly expanded Silver Eagle production. So we'll see. All this shit will come out soon enough. But for now, hang in there. Just hodl. Crypto's in your own possession. Silver in your own possession. I can't stress it any stronger. Who knows what's going on in Israel? The timing of it is very suspicious, if you ask me. I did see a building fall down at free fall speed again, which tells me, oh, great, another 9/11 type of thing. You don't even need to go there. YouTube will probably kick me off if I said that. So I'm not saying that anything other than I saw a building fall at free fall speed. So you draw what you will from that. All right, that's what I got for you. Be back on the hunt of the U.S. Mint tomorrow, because I don't want them using their massive derivative book to rig the game. And I don't think their annual report comes out until January. That's when we'll know how much they made or lost on their derivative book in the fiscal year of the U.S. Mint, which ended in September. All right. By the way, I posted the Jenny Moonstone discussion. Amazing. I mean, a lot of these were blind targets. I write something down, put it in the envelope, and she'd do a reading, never even sing it. Unbelievable. She just nailed so many of it. This one's called Deepest Secrets Revealed, False Flags Satoshi Found, Bush Horror, Silver Slayer, and much, much more. Go check that out at roadtoruta.com. Hit subscribe today, and we're still giving out, at least for right now, Veritasium tokens for a 1-year subscription. We'll mail it to your front door. You don't even know how to. It doesn't matter if you know how to deal in cryptos at all. Stick that with your silver and just hang on. Hold on for dear life. This is Bix. I'll talk to you later.